First of all, good evening to everybody. Thanks for attending this new webinar of our series of webinars. We will be take until November actually. So we'll, if you are patient enough to follow all of the episodes, we will be together for a few weeks again. So tonight, we will be ideally have a deeper dive into what we have already talked about last week, which is basically profiling the areas with using volume. Last time we've talked about volume profile. Maybe we can have just a quick look at what the S&P 500 is way is developing throughout the intraday session, looking at the profile, actually the volume profile, and what we said about it last time, so we can make a quick recap. And then we will move on talking about the market profile, which is basically like a very near relative of the volume profile. It could be like the cousin of the volume profile, but it just comes with different basic features. So it will still express where acceptance is, where auction areas are, but using a different parameter, which is not exactly volume as it goes for the volume profile, it is time, which is another second very important parameter in order to measure and actually identify and detect where acceptance is, as opposed as where there wasn't acceptance of price. Well, first of all, taking a quick look back at what we said last time and about volume profile and comparing it to the way actually S&P 500 is developing the current intraday session, we can see that we are, first of all, well, we had a very massive drop for the the prior 4, 5, 6 sessions. We made this this relative high at 4,500 even, more or less, in 30 days an area, and we made this massive drop of over 200 points. So, according to this long-term lecture, we can also see that the intraday session developed a nice trend to the downside. Okay, so of course, the volume profile is showing what a lot actually of acceptance at the very low of the day, at the very bottom area, at the very bottom range of the intraday range. And we can tell that by what? By volume profile building a slight distribution area exactly where the price is trading right now, which is roughly 10 points away from the low of the day, which isn't that much compared to the overall of the average daily volatility for the S&P 500. This is already an important information because it's telling us that market, as it goes down, it finds agreement in both buyers and sellers as it goes and as it discovers new price to the downside. So definitely, we are not having a proper rejection of these new areas, and because of that, of course, price is not just falling too quickly. It is distributing, so it is exchanging volume, it is developing volume, and we have basically agreement. That means that, first of all, price is feeling comfortable when we have agreement, and therefore volume transactions. That means that buyers and sellers feel comfortable with the new reached prices that the intraday move has reached. And on the other side, it shows also what? That we are, compared to the specific area, we are finding acceptance. But if we compare these informations with the entire daily range of the daily profile, we are outside the value area, the one we talked about last time, which is the one you can see here, um, this area, this blue area, identifying the standard deviation of the POC, which is this red, sorry, that's not red, this magenta line within the profile, which is ideally point of control. That's the price, the most traded price throughout the entire day, throughout the entire session. That means that we are basically very discounted. The price trading at the moment, it is a price perceived as a very discounted price. So we are really imbalanced to the downside. We are slowly finding acceptance, new acceptance in prices where priorly were considered as discount. So we had what is called a volume and acceptance shift to the downside. That means that, as we said in our first webinar, looking at that information and interpreting it this way, that means the price is going down accompanied by volume. Okay, we can see that price also leaves as left here, not very far away from where we are actually, but going down and building high volume here has left some low volume area behind it, behind this area. And as we said last time, low volume areas can identify areas of rejection as well as area of quick traverse, price quickly traversing those areas. In this case, though, we can tell what? That if price is building acceptance here and it somehow failed already in this candle here, and we can watch it even more closely here, it just failed to go up and quickly traverse this low volume area we had left above. That means there was no acceptance at all to just go back and make a retracement to higher and prior levels. Sell buyers, even if this price was so low compared to the overall daily range, buyers here were feeling that those prices were too high to buy. That leads to rejections and tends to bring back price to the immediate balance area where we came from. So in this case, of course, that's the area within this auction with the most volume trading. It's local POC, this high volume area, which we can consider as the local POC. The local to be intended as the highest peak of volume within the distribution curve, distribution bell curve. So definitely that gives us a reading of the volume structure the market is developing so far. A bias, sorry, a bias which is still to the downside. So there is what is called an asymmetry. There is an acceptance moving always more to the downside. So this is in terms of volume, what in terms of price action is normally called price is trending to the downside. Okay, this is the normal classification of trend, okay, of trending market that we tend to use just looking at price. In terms of volume, we can tell that, we can say that we have directional market when price is looking for and actually is finding acceptance, so is looking for value to the upside or to the downside. And this is very well expressed by, for example, rejections. Rejections in the volume profile, in the low volume area of the volume profile, give us a very good clue of areas where actually such rejections and in such indication of where acceptance is going towards can occur. Okay. Of course, if you have some questions about that, about what we said last time, feel free to text those questions in the chat, and I will be glad to answer them as soon as I can. No, I would just wanted to make a quick recap, but then after, I want to quickly move on, starting from these concepts of value, acceptance, and volume structure, introducing another amazing tool allowing us to read and actually both reading, both where previous acceptance of price was and how actual currently acceptance is developing. This tool is, of course, volume profile, as we said last time, but another great help comes from the market profile, which is this tool. Okay, I know maybe some of you already use it, but for those not using it yet, I am aware it can look scary at first sight because it comes with a very different structure compared to ordinary price bars or ordinary volume profile. But the very first thing we can just notice just by looking at it is that every single profile now I'm gonna explain to you how it forms and what it does actually represent, but we can already spot that every single profile comes with a shape kind of recapping the bell distribution curve shape, which we have already talked about in the volume profile field. Okay, and of course that makes sense because market profile is what also known as TPO profile, which stands for time price opportunity, was actually the first tool being launched in 1983 to just represent volume according to the price. So volume not intended to be represented by time or other parameters, but representing volume and acceptance actually divided by price tick. So for whatever area, exactly as well as the volume profile, that will show the most in the areas of market where market participants were agreeing at the most. So where price, which prices were more accepted, which prices were less accepted by market participants. First thing to talk about, how does it form? Well, you will notice that every profile is made by letters. Okay, we don't have price bars, we don't have volume histograms, we have letters. Some of the letters are not overlapped by other letters, by new letters. Some others do. Okay, what's the criteria according to which letters do overlap previous letters which have formed? Well, the main parameter is time. First of all, A TPO profile usually would represent one session. Okay, so every profile you can see here in this chart corresponds exactly to a single session, so one day. So that was the 25th of September, that's the 26th of September, and that's today, 27th of September. Well, there are many ways to set this tool, but the way I actually prefer, the setting that I prefer is filtering out what is called the RTH session. So whatever you see here within the single daily profiles, don't take in any consideration what happens before 3:30 p.m. Italian time, which actually correspond to 9:30 CME time, which is exactly the time where the cash session opens and the so-called RTH session starts. I'll explain you in a while why I prefer to have this setting. Why do I prefer to use this setting? Because in order to understand that, we need to understand what's the main parameter of the way market profile forms and develops, which is time. More specifically, every letter, you can see here, A, B, C, and so on, every letter is what is called a print. So we have the A print showing a range of prices, okay? Then we have the B print showing another range of prices, and we have C print showing another range of prices, and so on. Every print represent an half an hour of price, so 30 minutes. And according to the time of the opening, of course, the A letter, being the first letter of the alphabet, will represent, conventionally speaking, the first 30 minutes after the market opens, after the cash session of the market opens. The RTH sessions, basically. Okay. And if a single letter expresses the range where price has been trading throughout within these 30 minutes, it gives me exactly a range. Let's say we can compare every single print to a 30 minutes candle, to a normal 30 minutes candle. So let's assume market opens, the RTH session opens, and we have a 30 minutes candle going like this. Opening here, makes a quick spike to the upside, then it goes all the way down and it will close here. This is the 9:30 candle. We will have a market profile starting to print the A letter this way. So it will start from here, it will represent the spike to the upside, and it will go down. Of course, it will go down. It's not gonna print a new letter here, as the areas, those prices have already been traded within that print, within that period, within that half an hour period. But then it will print some new letters going down because those levels of prices are still fresh. Okay, so we will have something like that. Okay, then it is 10 o'clock CME time. First 30 minutes candle closes and a new war opens. We will have maybe a quick retracement to the upside and then another probe to the downside. So opening here, closing here. Here we will have, of course, the B letter being printed right here. It would overlap to the previous A letter because, of course, the opening price of the second half an hour from the cash session would trade exactly same levels which has already been traded by the first half an hour. So letters would overlap here. Market goes up, so we have another quick overlap of letters because still this candle is trading prices which has already been traded before. Okay, then it continues down. Of course, the B print will find fresh prices, so that wouldn't overlap with any other previous bars. Then 10 o'clock candle closes, 10:30 candles open, make a quick spike down, and it retraces all the way up to here. So we will have something like that opening here with the C print making a low, then going all the way back up, and of course still overlapping the B print here because those prices were already traded before. Here it would overlap to two previous prints because those prices have been traded by two previous prints, and I will just close here. Then here a new candle open, and maybe we will have a D going up. We will have something like that, okay, and so on for the entire day. So first important principle to talk about. We have, of course, by such representation, actually a visual representation of which prices were most traded, of course, but not really in terms of volume, but in terms of time. In fact, since every single print represents half an hour of trading prices, wherever we have the most important peaks in the TPO profile, we will also have prices where time, prices where market has been spending the most time. And therefore, according to time, the most acceptance was found on those prices. In fact, in this case, if we look at the ugly drawing I made of this profile, this example of a market profile, these with 4 overlapped prints, it gives us what is the POC. So the price, the highest peak within the entire profile, exactly as well as for the volume profile. The only difference is that we are not talking about volume necessarily. We are not talking necessarily about volume here. We are talking about time. So this is definitely in such a profile where price has been spending the most time. So according to that, that shows us the most important level of acceptance of price. So where buyers and sellers were in agreement. Now, of course, a POC, it doesn't necessarily correspond within the same day with the volume POC given by the volume profile. Well, I would say it almost never corresponds. Okay. Maybe that was more true back in the 80s, where markets were so different by what they are so right now. There weren't icebergs, there weren't HFTs, there weren't algos. So it made more sense back in the 80s to say, well, price has been spending lots of time there, so by spending lots of time there, there has to be also more volume being traded over those areas. Okay, this isn't 100% true nowadays, but it doesn't matter because today, even if we have some discrepancies between important levels given by the market profile and those given by the volume profile, They still, if we combine those informations together, we can still get a good lecture of market, because we just have two different dimensions of acceptance, of an interpretation of acceptance. And on top of that, volume profile comes with, of course, some features for which I would say I prefer the volume profile to the market profile. But for other informations, I still definitely prefer the market profile to the volume profile. I'll tell you why. Well, first of all, market profile comes with a more standard shape. Okay, we can have areas where maybe lots of volume in the volume profile can give very skewed distribution areas. So the Bell distribution curve sometimes can be really tricky to be understood properly, because sometimes high amounts of volumes being traded in certain areas would just give a funny shape to what the normal volume profile uh, tells. In market profile is everything more objective, especially when it comes for low volume area, also known as single prints, and as well as highs and lows. It gives me definitely a first more accurate impact on understanding what kind of extremes for the day, for the current day, and for the previous days we have. What I called asymmetries. I'll go back into that in a few minutes, but according to what we just said in terms of market profile, um, expressing acceptance by the time point of view, now you will definitely understand why I set up my daily profiles, my daily TPO profiles, filtering out the ETH part of the session. First of all, because the RTH session would just include a few hours, okay, more specifically 7 hours and a half. If I would decide to, so I will definitely have less prints showing on the market profile, but those are the most relevant ones, because during the overnight, during the what is called the overnight session, so the ETH session for American markets, so S&P 500, Nasdaq, the Dow Jones, and so on. During the RTH session, we have the 80% of volume traded compared to the 20 exchanged during the ETH session. So, of course, if I want to decide which prints to be shown and which prints to pay more attention to, of course, I would choose those containing the 80%, representing the 80% of volume. If I had to look also at the volume and the market profile starting from midnight GMT plus 1 time, that means my time, I would still have those 7 hours and a half of RTH session plus 15 more hours, but with a very low amount of volume being traded compared to the volume which counts, which really counts, the one exchanging during the RTH. But so that means I will have over 22 roughly prints 22 letters, which will give me more weight, of course, to the shape of the market profile, but unfortunately, 15 of those 22 prints would just come with an insignificant volume. So that's the reason why I want to filter out market profile this way, only looking at the RTH sessions. Well, another way of filtering out or at looking at market profile is splitting the market profile between ETH and RTH. So looking at a specific profile representing only the ETH session, the one which is less representative in terms of volume, and the RTH uh, compared to the ETH session. I'll make you an example of that, so we can also go through some of the functions of the platform and looking at also at the practical use of the information provided by the market profile. If we just now take out the filter that I've set, going at the TPO indicator here, that's the way I was telling you I've set it. So from 9:30 exchange time to 5 p.m. we can also decide to have it split. Okay, so in this case, for each day, I will have like 2 sessions. Okay, and oh, I need to do another thing though. I have to remove the limit from the price representation as well. So let's just allow a few seconds for the chart to reload. And we will see that for every single day, we will have 2 different TPO profiles. Here it is. So, for example, 26th of September, the first one you can see here developing at the beginning of the day, that would represent the ETH session. So basically the morning European time, and that's the RTH session coming after. So every single day comes with 2 different TPO profiles. And basically, what's the most important information if you look at market profile this way? When we have the opening, are we opening with the A print inside or outside the value area of the ETH session? That means the value area, as well as we were talking about in the volume profile, is expressed by this graphical template I have here by those 2 dashed greenish lines. Okay, so that's the value area high for this ETH session. That's the value area low, and that's in pink the POC for the ETH session of that day, yesterday, basically. Okay, so that means that if we take in the overall consideration these few hours of trading, even if volume maybe wasn't that strong because we're still talking about an ETH session, this is where we had value. So this area is where we had acceptance. So where basically buyers and sellers were in agreement about those range of prices. Okay, now So this is where market is supposed to be balanced between buyers and sellers' actions. Now, market opens. That's the A print of the RTH session. What does it do? How does it move? Well, it's starting to trade within the previous value area, the one from the morning, but then apparently it fails. Apparently it fails. Considering that the A print, well, we don't know according to the only just by looking only at the market profile if the beginning of the A print was here, here, or here. We don't know that. We should also use this information. We should also use this information accordingly to a sorry, I think there is a problem with the microphone. Okay, that's not it though. Oh, sorry guys, give me just a few minutes. Okay, should be fine now. So we don't know by just looking at the print if we have price opening here or opening here or opening here. We only know that's the range of the first half an hour of the opening, but we can also complete this chart or just look at another chart with candles actually and looking where price opened. But looking at the closing, the way this A print has closed, we can tell since the B print then starts somewhere here, we had a rejection of what the previous area of balance was. So what happens when price accepts actually outside an area of a previous balance was established? It is imbalanced. It doesn't feel that area of previous acceptance accepted anymore. It gets imbalanced. And then, if it gets imbalanced, though, it means that it's not perceiving those prices anymore as premium, fair, and discounted anymore as it used to be, though. But unfortunately, price perception changes. That happens for financial instruments, that happens for any good, any service. Let's get, for example, a smartphone. 800, if its fair price is $1,000, $800 may sound cheap until the smartphone is still new. But if you already know that a new model is coming into the market in a couple months, the perception of $800 as cheap price won't be felt that cheap anymore. Maybe the value is gonna shift to the downside, maybe somewhere around $500, $400. Okay, so same thing happens with auctions. Once price accepts outside previous areas of balance, we can say that price gets imbalanced. And if price is imbalanced, is trying to do what? Looking for a new balance somewhere else. Looking for a new balance somewhere else. And where is price more likely when is it imbalanced to find a new area where it can find a new balance? Well, maybe previous areas of an already established balance which has been established before. So market always tends to move between areas of balance and other area of previous balance. When that doesn't happen, price, it means that price is just not imbalanced. So until we are within a previous area of balance, market will just tend to trade within those areas and stay actually balanced, still respecting discounted prices as discounted price. So the responsive action we were talking about a couple webinars ago is still in play. On premium areas, responsive selling will still supposed to be in play, and its POC, it will just be the maximum point of balance of those areas. So talking about these, we can detect two different behaviors of price, two different status of price. Balanced price, which will normally give us rotational situation, rotational sessions. So the first implication when we have rotational days is that first of all, market is not likely to be moving in a volatile way. It's just supposed to be ranging around, because it will be balanced by buyers and sellers interacting together and facilitating trades. Unlike this, when market is imbalanced, it tends to do what? First, volatility will increase, and market are not rotational but directional. So we have the most of the trades trading in one specific direction. Most of the intentions would be in a specific direction, going away from a previous balance and going towards a next area of previous established balance. In this situation, this is where we have trending days. So if we revisit a little bit the the concept, the principle of trending market, when do we have trending market? Yeah, of course, when price moves directionally. But why does price move directionally? Because it's looking for a new value, for a new area of balance in a specific direction. That's it. Trend will just stop, is likely to be stopping where market will find another point of balance after losing the previous balance. I know this may sound to you a lot theoretical, but let's just look at the previous day compared of this one. ETH, that's the value, okay? In the RTH, we had, let me just zoom out a little bit. That was the balance. We have a price opening somewhere here around the A print, but we can say that slowly there is a rejection of the lower part and more prints being overlapped back within the previous area of balance. This is the opposite example that we have just made about this day. On the previous day, we had the market accepting and rejecting the areas out of the balance of the ETH, accepting back into that area and still continuing to build acceptance on that range. So it has confirmed what it has happened in the intraday. That means on the 25th of September, we had basically a rotational day. Since from looking at this information, we could tell we had a rotational day. So we were definitely expected to see a market moving too fast or building a strong directional move, because market profile already couple prints after the opening has told us that acceptance was back within the previous area. So ideally, rotational day. This is one of the best informations the market profile can ever give, as well as asymmetries. Because another thing I want to talk about in these last 10 minutes, but then if that's necessary, we can also recap something and add something in the next webinar, is market asymmetries. So we just said that wherever we have more prints, the more acceptance we have, right? And we also said last time that normally the extremes of the day are normally supposed to come with less acceptance rather than middle areas of the both market profile and volume profile. Cool. So normally, let's say a good extreme in order to consider that a stable high or a stable low of the day is normally supposed to come with just one print, one letter, so no overlap of letters of more than 2 letters. That's a good example. Here we only have 2 ticks with the E print. Here we have just one with the O print. Here we have 2 with A print, and so on. Those are good highs, actually, because having only one print at the very extreme, it means that there wasn't that much of acceptance over there, which is what is supposed to happen on an edge, on a profile, since in this case we are talking about a high, so it's supposed to be a premium area. Okay, so not that much of an acceptance. Of course, this isn't exactly that way when we have what? 2 prints or more on a low or on a high. This is a very 2 overlapped, at least 2 overlapped prints. In this case, we have NO prints here. Also here, we have 2, this one, 2 overlapped prints at the very low of the day. This is what are called weak highs or lows. Okay. Weak highs or lows. Why? Because having 2 or more prints at the very bottom or top edge of a TPO profile would, of course, be a sign of an anomaly. An anomaly, why? Because that shows a weird interest on the very lower or higher part of the profile. which, according to the auction market theory, shouldn't be there. In order for that to be a good low, for instance, let's make an example on this one, we shouldn't be having too much activity at the very low of the day, because uh, such an activity on the very low of the day implies many sellers being interested in selling also that level. Otherwise, if also sellers weren't there, there couldn't be too much activity given by buyers only. Okay, if there were a proper responsive buying on the low, we should, yeah, we should see many buyers, but quickly taking the price away from that level. Since it stayed there for a long time, that implies a weird acceptance of the very low, and also many sellers being there, and also on a secondary point of view, also buyers actually struggling to take price away from that low, and therefore spending more time over the level. So the implication is that when we have a weak high or low, this is quite likely to be taken out. This is a low which is not that stable, which it happened in the following session here, and it happened just a few hours later here. Now, by those weak highs and lows are being likely to be taken out, by taken out, I just intend violated. Okay, doesn't mean they have to be broken with a proper breakout like this or like this, but normally are market areas which at least tend to be retesting and violating those a little bit, because it's that shows an anomaly which is very likely to be corrected in the near future. Then there are a few statistics about S&P 500 and the Nasdaq, according to which there is a relevant percentage of weak highs or lows being taken out within the session, within the next day, within the within a couple days. I'm not gonna go through that because it will take way longer than the time we have. But this is an interesting point of view because it tells us what? An asymmetry. If we look at market from during this TPO here, we can see that at the top, the high is good. At the bottom, we have a weak low. So we have a market being more likely to go to the downside because the high was properly rejected with no acceptance, not that much of acceptance at the high, and the low being still interesting for both buyers and seller. In fact, we can see that as soon as market reaches that level, look how much acceptance there still was over there. As well as here, three prints. So there was definitely interest. And weak highs and weak lows tell us a little bit in advance, like a small warning light, where those levels are located. And of course, if we have a proper high or low in the opposite direction, that gives us a good asymmetry. Then, last concept, last concept for today. If we have, when do we have not a good high, but a wonderful high or low? When we have a reversal tail. A reversal tail is a single print taking a nice number of ticks of price. The single ticks, of course, it expresses a good high, but it is particularly good as a high when this single print forms like a tail. So let's see if we have another example going in prior TPOs. Yeah, like this. Oh, that's amazing. That's amazing. So why do reversal tails are so good in determining a good low in this case? Because since we have only one print taking so many price, that implies that we have what is called a V reversal. Price within the very single print, so quite quickly went all the way down and came all the way back up, determining what around this area can be defined as an excess. Excess is almost a synonym for rejection. We have price getting away quickly from a previous area, which apparently wasn't accepted at all. On the other side, it was rejected very, very quickly. The velocity of this rejection, this is what it makes the excess. And that's completely the opposite of what a weak high or low is, where we had market transacting a lot, spending lots of time there, and therefore telling us an anomaly of an acceptance on an extreme of the day. Okay, guys, I hope we have gone through many concepts tonight. I hope you could enjoy them and you could easily follow them all. If it's necessary, next time we can go quickly through all of these once again. Of course, if you've got some questions, feel free to ask me. Um, and of course, we still have something to say about the volume dynamics in terms of determining the structure, talking about the VWAP, what we'll be talking about next week. So just in case you have some question, please let me know. If we run out of time, please, Alex, let me know.
No. Actually, I was talking about my microphone. It was mute. I was saying that the Q&A is open. If somebody has a question for you, they can write the question down. It's open for everyone. Great. I think you have.
Okay, yeah. Reinhard, what is the best time frame? Well, there is not a time frame for TPO charts because they would just represent the entire day, the entire session. If you want to have a quick and easy way of looking at these, I would recommend to set it this way. So divided between the ETH part of the day and the RTH part of the day, and maybe if you want to combine it with a single chart, with an ordinary chart, I would recommend then to use a 30 minutes time frame, so you can see the correspondence between every single print and the corresponding candle. Okay. You're welcome.
Hmm. Great, Eduardo. So if everyone else hasn't got any questions, right? It was a great webinar one more time.
Thank you.
And we can say to everyone to have a good night and to have a good rest.
Good night to everyone. Thank you again and see you next week.
Thank you, everyone. Have a good night. Thank you, Eduardo. Buonanotte.
Cheers. Buonanotte.